I want you to think about this for a second. You bought your home for $300,000. You just sold it for $650,000. That's a $350,000 profit, and you're already thinking about what you're going to do with that money. Then your accountant calls and tells you that you owe the IRS tens of thousands of dollars in capital gains tax. Here's the part that should really bother you. You probably didn't have to pay that. If you had made just a few specific moves and understood one rule that most people only learn after they sell, the entire tax bill could have been close to zero. In this video, I'm going to show you exactly how to legally pay zero capital gains tax when you sell your home. And stay with me, because strategy number 5 is the one I see people miss constantly, and it's the most expensive mistake. Whether you're thinking about selling in 6 months or 6 years, this matters because the decisions you make today determine how much of your profit you actually keep. I'm Jacqueline Shattuck. I'm a certified financial planner, and I help families protect and grow their wealth through major financial decisions like selling a home. And what I see over and over again is people walking away from the closing table, not realizing they just gave the IRS money that they probably didn't have to. So today we're fixing that. I'm going to walk you through the rule that allows you to keep up to $500,000 tax-free, the 3 tests that you must pass, the 5 strategies that actually save you money, and a checklist you need before you ever list your home. First, big picture. Normally, when you sell something for a profit, stocks, rental property, a business, you pay capital gains tax. It's standard. But your primary residence is different. The IRS created something called the Section 121 exclusion, and it's one of the most generous tax breaks available. If you're single, you can exclude up to $250,000 of profit tax-free. If you are married, filing jointly, that number jumps to $500,000, completely tax-free. That means a married couple could walk away with $500,000 in profit and owe nothing. But you only get that if you qualify. Quick question. Are you thinking about selling your home in the next year, or are you just planning ahead? Drop that number in the comments. To qualify, you have to pass 3 tests. Miss one, and you can lose the exclusion. First is the ownership test. You must have owned the home for at least 2 years within the last 5 years before selling. Not 5 years total, just 2. And they don't have to be consecutive. Second is the use test. You must have lived in the home as your primary residence for at least 2 years within the same 5-year window. This is where people mess up. You can own a home for 10 years, but if you only lived in it for 18 months, you don't qualify. You need 24 total months. Third is the frequency test. You can't use this exclusion more than once every 2 years. If you've used it recently, you may need to wait. If this is helpful for you, hit subscribe. I break down tax strategies like this every single week. Let me show you how powerful this actually is. You buy a home for $300,000. You sell it for $650,000. That's a $350,000 gain. If you're married and you qualify, you pay 0 taxes, none. If you're single, you exclude $250,000 and only pay $100,000. That's still a big difference. Now, here's where most people lose money. Strategy number 1, your cost basis. Your gain is not just sales price minus purchase price. It's sales price minus your adjusted basis. Okay, stay with me. Your adjusted basis includes what you paid plus major improvements, plus certain closing costs, plus selling expenses. So if you spent $65,000 on improvements and $25,000 on selling costs, your gain drops dramatically. That alone can save you thousands. Be honest, do you actually keep your home improvement receipts, or are they buried in emails somewhere? you might want to start making a list. Strategy number 2, the partial exclusion. If you don't meet the full 2-year rule, you might still qualify for a reduced exclusion if you move for work, health, or unforeseen circumstances. If you live there for 1 year, you might still get half the exclusion. There's $125,000 tax-free if you're single. Most people don't even realize this exists. Strategy number 3, converting a rental property into a primary residence. Rental properties don't qualify for this exclusion, but if you move into that property and you live there long enough, part of the gain may qualify. It's not perfect and there are extra rules, but it can significantly reduce taxes. If you own a rental property, drop yes in the comments. I may do a full breakdown on that strategy next. Strategy number 4, understand what actually counts toward your basis. Improvements add value, like a new roof, kitchen remodel, or an addition. Repairs do not, like painting or fixing a leak. This distinction matters. Misunderstand it and you either overpay taxes or you risk issues with the IRS. Now, strategy number 5, the one almost everyone gets wrong, timing. Timing can be the difference between a massive tax bill and zero. First, don't sell too early. If you're at 22 months of living in the home, waiting 2 more months to hit 24 could unlock the full exclusion. I've seen people lose tens of thousands of dollars just because they didn't wait. Second, watch the 2-year rule. If you've used the exclusion recently, you may need to delay your sale. And third, think about your income. If you sell during a lower income year, you may pay a lower capital gains rate or even zero on the taxable portion. If this is changing how you think about your money, hit that subscribe button for more. Now let's bring it all together with a quick checklist. Before you sell your home, confirm it's your primary residence, count your months, make sure you hit 24 if possible, gather every improvement in selling record, check if you've used the exclusion in the last 2 years, and think about timing, both months lived and income level. And if it's not your primary home, explore other strategies before assuming it's fully taxable. Screenshot this part because you're going to want it later. And before you go, here are the biggest mistakes I see. Assuming all expenses count towards your basis, they don't. Not keeping receipts, this costs people real money, and selling too early, missing the 24-month mark. And assuming rentals are always fully taxable, they're not if you can plan correctly. Which one of these do you think is most at risk? Drop it in the comments for me. Here's the bottom line. The difference between paying zero tax and paying tens of thousands often comes down to a few decisions and a little planning ahead of time. If you're thinking about selling and want help running your specific numbers, there's a link in the description to schedule a conversation. No pressure, just clarity. If this helped you, hit like so more people see it. Subscribe for more strategies like this. Stay golden, and I'll see you in the next video.